So you build up a solid portfolio in Germany. You're feeling good, diversified, long-term focused. But then you hear something unsettling. What if my broker goes bankrupt? Does that mean your hard-earned investments vanish overnight? Is your money safe? What about the 100,000 euros deposit protection? In today's video, I am going to break it all down. You'll learn what really happens when a broker goes bust, whether ETFs are protected like bank deposits, and how can you reduce your risk without panicking. This is what happens if your broker goes bankrupt. By the way, if you are new to the channel, my name is Essen, and on this channel we discuss how to build wealth in Germany. Before we dive in, if you are an expat trying to make sense of investing, taxes and long-term wealth building in Germany, I want to personally invite you to my online premium workshop, the Expat Wealth Blueprint. It's a deep dive session where I share my blueprint on building wealth as an expat in Germany. Check out this QR code or the first link to learn more and reserve your spot. Now let's get started with the 100,000 euro question. Literally, many people ask, is my portfolio protected under the deposit guarantee scheme up to 100,000 euros? And the answer is no. That protection only applies to cash deposits at a bank. Your checking accounts, saving accounts, maybe even your money market account. If a bank collapses, the German government or relevant EU authority will guarantee up to 100,000 euro per bank per person. Sounds good, right? But here's the catch. In a massive financial crisis, that promise might get stress test. That's why many expats, myself included, suggest not holding more than 100,000 euros in total bank cash deposit, even spread across different banks, just in case. The good news is that ETFs and shares are not bank deposits. They're not even part of the bank or broker's balance sheet. Securities like stocks and ETFs are classified as Sondervermögen or special segregated assets. Special funds is a legal term regulated in the Capital Investment Code, formerly the Investment Act. Simply put, it refers to the money that you, as an investor, have invested in stocks, funds or ETFs, for example, with an investment company, legally known as the capital management company. So the special fund is separated from the assets belonging to the capital management company itself. That means your stocks and ETFs do not belong to your broker. They are held in custody separately, usually by a third-party clearing institution. Even if your broker or the ETF issuer goes bankrupt, your shares remain untouched. Here's a simple analogy. Imagine your broker is a storage facility. You rent space there and you store your belongings, in this case stocks and ETFs. If the storage company goes out of business, you don't lose your stuff. You simply pick it up or it's transferred elsewhere. The company was just holding it. This setup applies even if the fund provider like iShares or Vanguard goes bankrupt. They're just managing the fund. You still own the underlying assets like Apple stock or government bonds in your name. So if a broker or fund provider goes bankrupt, your ETFs and stocks are still yours. But what does happen if your broker goes bankrupt? Let's say your broker goes under. What happens next? The first thing would be temporary access issues. You might temporarily lose access to your account. That's stressful, but not catastrophic. Then there will be an asset transfer. Your securities like stocks and ETFs will be migrated to a new custodian or broker. In some cases, you may even be able to choose the destination. In the great financial crisis of 2008, investors of security holdings didn't lose their assets when the large banks collapsed. Their securities were eventually transferred to other brokers. However, and this is very important, if you have invested money in the so-called derivatives, you risk total loss if the issuer of the derivative becomes insolvent. Derivatives are complex financial products that do not invest directly in stocks, bonds or ETFs, but are merely derivatives of them. As derivatives are not special segregated asset, they are just promises of a bank or the issuer. So only invest in complex products like derivatives, warrants, puts or calls if you know exactly what you are doing. But what about cash in the investment app or broker account? Now here is an important point. While your stocks and ETFs are protected, cash sitting in your brokerage account is still not necessarily safe above the 100,000 euros. For example, uninvested funds waiting to be used, dividend payments that haven't been reinvested, or interest from bond ETFs. That cash is just like money in a bank account. It may fall under the deposit guarantee scheme, but only up to 100,000 euros, and only if your broker uses a licensed bank partner. More on that later on in the video. So it's smart to keep excess cash elsewhere or reinvest it promptly. Also understand the parent and holding institutions. Let me explain. Many neo-brokers and neobanks are simply an interfacing medium, meaning that they offer services backed by another financial institution. Superficially, you might be using two different banks, thinking that you have up to 200,000 euros insured. But at the back end, both the service providers might be using the same bank. And under the law, only 100,000 euros per person per credit institution is covered. So make sure you keep that in mind. Talking about insurance, if you hit the like button and turn on the notification, I assure you to keep sharing videos on how to build wealth in Germany. We just talked about splitting cash amounts with multiple banks, but should you also spread your stocks and ETFs across multiple brokers in case one of them falls? Yes, you can distribute your investments with different investment apps, and actually I use multiple brokers myself and encourage people to do so, but not because of the deposit protection, because that doesn't apply to stocks and ETFs anyway. The main benefit of using multiple brokers is reducing operational risk. For example, if broker A goes temporarily down, you can still access broker B. If one platform has technical issues or cyber attacks, you're not fully locked out, and you can also take advantage of lower fees or different product ranges using various investment brokers. Now, this isn't strictly necessary, but for peace of mind, it is definitely an option that you should look into. Sticking strictly to ETFs, are all ETFs equally safe? The answer is no. Not all ETFs are covered and safe. Be careful with synthetic or leveraged ETFs. These use derivatives or financial engineering and carry counterparty risk. Sticking to physically replicated, globally diversified ETFs should be looked into if your goal is safety and simplicity. So this means that investing through a neo-broker is riskier than using a traditional bank. Not inherently. Neo-brokers are also regulated and use custodian banks to hold your assets. The legal protection of stocks and ETFs as Sondervermögen applies regardless of platform. You can easily check if your broker is trustworthy. Look for BaFin regulations by simply going to this website, add the name of the company, and check what they are allowed to do and what not. Also make sure that there's a clear ownership and custody structure. For newer companies, it might be difficult to see an established track record, but if they are backed by licensed institutions, this can be a good sign of trustworthiness. Even if your broker is safe, it's no guarantee that your money is safe, because stocks and ETFs can drop in value if the markets do. Broker safety protects custody, not market performance. That's why long-term investment and diversification are crucial. But if you still don't feel confident about investing in the stock market and you're serious about building long-term wealth as an expat in Germany, then don't miss the chance to join my online premium workshop, the Expat Wealth Blueprint. In one session, I'll walk you through my blueprint of creating wealth and avoid the expensive mistakes most expats make with their money. So click the link in the description to learn more and sign up now. And if you think you're not at a place to start investing, in this video, I share 5 levels of wealth in Germany and how to move up from your current level. So thanks for watching Black Vision, and I'll see you in this video.